Okay, we are live. At least it looks like. What is up, gang? This is a new experiment. This is something we're trying. I am checking my. Yes, there we are. Okay, it's working. I'm just checking it on my phone. Sorry. Yeah, this may be a disaster. I don't know. We'll see how this goes. It's first time deal, and I'm thinking about doing these things. Just going live for a little while on Monday nights, calling it Monday Night Live. Wanted to call it Monday Night Raw, for you WWE or WWF fans back in the day. Raw seemed a little aggressive. So Monday Night Live is what it is for now. But just hit on real estate and or local topics that may be helpful and that people have been asking me about. That's kind of the one thing I want to focus on. It's like, what do I get the most questions about at the time of recording, going live? And let's hit on that. So tonight we're going to talk about interest rates, which I know I always say is everyone's most favorite exciting topic, but it is actually something that people want to know about a lot because they're really low and they came up really fast, and everybody wants to know what's going to happen with them. Where is it going to go? And there are things going on in the world right now. One thing in particular that could dramatically change what's happening with mortgage rates and could shift away from what was supposed to happen and what the Fed and Jerome Powell have said was going to happen, and maybe changing things. So we'll see how this goes. I'd like to bring guests on here at some point. Right now it's just me, but we're going to kind of look into it and see what's going on. So first of all, where to start at the beginning? Mortgage rates. If you don't know, you probably know. One of the things that fueled the house buying frenzy and the absolute crazy market in many parts of the country during the pandemic, so 2020, but really 2021, and then even into 2022, was these super low interest rates, these artificially low interest rates. And that was fake. It was. It was real. It happened, but they were that low when you're getting rates in the low threes and the high twos. They were kept artificially low, is the way a lot of people look at it, and the way I say it, by the Federal Reserve and by the U.S. government to try to encourage economic activity. They don't actually lower mortgage rates. They lower different interest rates. The Fed fund rate is the main one that mortgage rates are tied to, and that's what they play around with. And so during the pandemic, when everything shut down and the economy briefly ground to a halt, it was, okay, we need to now stimulate people to get out there, to be spending money, and to be buying homes. And they sure as heck did that because, bring them down to that level. Even when home prices were rising so quickly, affordability was great for people because it's free money essentially. When you look at the difference between a 3% and a 6% interest rate on your monthly payment, it is enormous. And so that's what was going on. They were keeping those payments low, or those interest rates low, and so that was helping with monthly payments. And the market went crazy. And supply and demand. There was a ton of demand, so home prices went up quite a bit. And then the other thing the Fed did during the pandemic was give out free money, which you understand to a large degree. They were telling people to stay home, and you understand why they were giving out money. A lot of it was a pandemic unemployment. Some of it was just they were cutting checks for a while. All this money flooded into the economy and made people spend money. What happened then is things were too good. People were spending too much money, and inflation, or the job market was too good. Unemployment was low. So inflation came way, way, way down, or inflation went way, way, way up when that happened. And that's, everybody knows we're dealing with inflation. That's what we've been having the past probably year or so now since interest rates have risen. So once the Fed stopped artificially keeping interest rates low, right, they shot way, way up. And to the point where they're at 6.5%, actually over 7% now. They've risen again the past few weeks, came down a little bit this week. But so the Fed's doing this intentionally. It's kind of the opposite of what they did back during the pandemic. Jerome Powell, the chairman of the Fed, has literally said we need to make people stop spending money. We need to essentially raise unemployment and have people lose their jobs to make the economy worse so that inflation comes down. That's the only way to curb inflation, at least in this regard, is to make the economy worse. Curb consumer spending and have people lose their jobs, which is a crazy thing to say, but the job market and unemployment has been historically low for a while. I mean, it's fog a mirror, get a job. And so when people ask about housing crisis and that type of thing, one of the metrics that's tied to that is the job market. For a housing crisis to happen, for a crash, there needs to be a widespread job loss. That hasn't happened, obviously, and we really haven't even been close to anything like that. So that's one of the things that, despite the rapid appreciation in the housing market, has kept things solid. So okay, so interest rates shot way up because they stopped artificially keeping them low. And now everyone's, that affordability I talk about just got shot. And so, but they are still, the Fed is still determined to continue to raise rates, raise the Fed fund rate, and then which in turn raises mortgage rates because the economy is still too good. The job market is still too good and people are still spending money. So every time a report comes out, they say, you guys aren't listening. You're still spending money. We have to keep raising these rates. And so they've essentially promised another 50 basis point hike here in the next month. And so that's another 0.5% on mortgage rates. And so they're already over 7. And the idea is, the expectation is they will keep going up before they come down. And then a lot of people think they're going to start coming down at the end of the year and sort of stabilize. Some people think around 6, some people think below 6. That's been the idea. But the latest information, literally days ago, Powell said, we got to raise rates again. Then something happened, and that's something, let's see if I can do this. This streaming thing is all new, but let's bring this over here. Yes, that something happened is the collapse of Silicon Valley Bank on Friday. I didn't even know what this was. I'm guessing many of you didn't either, but it is one of actually the second biggest banking collapse in U.S. history, which blows my mind. Silicon Valley Bank is heavily invested in or has heavy ties to the tech sector. A lot of tech companies had their money there, past tense, because this thing collapsed. And the collapse of this bank could completely change the trajectory of what is going to happen with mortgage rates and could potentially bring them down a lot faster, or at least keep them from rising as they were expected to do. So what happened here with this bank? Well, there's a CNN article that talks about it. And basically it happened extremely quickly, which is what seems to happen with these things. The government is guaranteeing customer deposits. So it's not a bailout, but they are saying, hey, if you have money in there, you'll be able to get it out. And it is saying this is the biggest U.S. bank failure since the global financial crisis, which seems clickbaity, but is also quite literally true. Here's the deal. So what is Silicon Valley Bank? That just goes in to talk about this a little bit. It has there's a lot of tech companies. There's some real estate companies in there. Opendoor actually had a lot of their money with Silicon Valley Bank. Opendoor, I'm releasing a video about on Thursday. It should be an interesting one. It's actually about how to find deals utilizing Opendoor. Anyhow, they've been struggling for a while. I can't imagine this is going to help. But why did this bank collapse? That's what I always want to know. What happened? And so basically, a few things happened. First of all, the bank bought heavily into these U.S. government bonds when the U.S. government interest rates were super low. As we talked about, that went for bonds too. And then when those interest rates rose dramatically, the payments on those bonds also rose. And so when a bank is heavily invested in those, you have to pay more per month to pay that debt. And when that's happening, it's not good for your portfolio. You're showing the numbers here. The yield was basically their Silicon Valley's banks. Everything was looking a lot worse for them because they were invested in these treasury bonds that weren't worth nearly as much as they were when they bought them. And so the people in the know, this was concerning for them. And then after these interest rates shot way up, the bank came out and said publicly, hey, things aren't good. We basically just sold off a bunch of assets at an enormous loss. And what do you think that did? That caused their investors to panic, especially when you hear about a bank having big time struggles. And 2008 isn't that long ago. What happened? A lot of their customers withdrew their money in large numbers. And if you know anything about a bank, this is called a run. When there's a run on withdrawals, that is a problem for them because now they don't have the money that they need, which is a bank's whole job is to have money to lend out and to pay things. No, they don't have that. So quickly things imploded, really, and that all happened in the matter of it seems like 48 hours. So that's what happened. So what does this mean for everything else? Jerome Powell, there's our favorite guy. Every time he says something, mortgage rates go up. It seems like, at least the last year or so. So he's the chairman of the Fed, and this is a New York Times article which literally says the path is murkier after bank blowup. Basically, they'd been raising interest rates steadily for a year, and they planned on continuing to do that. We talked about they announced another 0.5% in hike in the Fed fund rate, but making big moves could be trickier amid instability. So what does that mean? It's all about stability and instability. And what I love about the financial markets, and I don't actually love them, but I find it kind of funny, is that it's all based on how people feel. The whole thing, we're trying to do this. Oh, investors feel this way. Investors felt a way and all started to withdraw their money, and now a bank failed because they got scared. And the same thing goes for what the Federal Reserve is going to be able to do and what happens with mortgage rates. So basically, New York Times just talks about what's been happening. They're basically, this is not mortgage rates, but this is the interest rates the Fed is raising. They're near zero. Now they're at 4.5%, huge change. And they have had to keep raising them to try to combat this inflation. But basically, job growth and consumer spending are too good. Like I was saying, people are still spending money, but 3 notable banks have failed. So the big one was Silicon Valley Bank. There's 2 other ones. There's one that just failed, I think, today being Monday. And so what does this mean? The tumult, which is a great word, and the risk that it exposed could make the central bank more cautious as it pushes forward. So basically, it doesn't want to blow up the US and thus global financial market again, because people are scared. All this depends on is emotion. So people are scared, and it doesn't want to cause more of these things to happen, more runs on banks, because, interest rates keep going up. That's one of the things that caused this bank to fail. Are more banks going to fail? Are we going to have another financial crisis because of that? After Mr. Powell's speech last week opened the door to a large rate change, investors had marked up their 2023 forecasts, but after a wild week in finance, they see just a small move this month and expect the Fed to cut rates just above 4.2% to 4.25% by the end of the year. So the JP Morgan economist here says, I don't have a ton of confidence. We'll see if these backstops have been enough to quell concerns. Yada, yada, yada. Goldman Sachs economists no longer expect a rate move at all. So that 0.5% hike that was supposed to happen, Goldman Sachs may know a thing or two. They don't think that is going to happen at all, because there's considerable uncertainty about the path. They think the Fed is going to wait a while to see how this plays out, because the Fed doesn't want to freak people out, because they know what people do when they freak out, and cause more institutions, more financial institutions to fail. So because of this, we could see a delayed interest rate hike or not see that hike at all. And that could help mortgage rates stabilize or even start to go down. Other economists went even further. I don't know who Nomura is, but someone the New York Times knows, is now calling for a quarter point rate cut, thank you, at the coming meeting. So essentially, mortgage rates aren't going up, they're actually coming down according to this projection. So this also depends on other things. So this is all speculation at this point, right? What we're reading is speculation. But there's another jobs report that's coming out Tuesday, I believe. There's another consumer spending report. Those will factor in too. If those are bad, which is essentially what the Fed wants at this point, then that will assumedly cause them to stop raising rates, because the reason they're raising rates is because those things are too good. People keep spending money. The whole thing is about inflation. We got to get inflation under control. At least that's what the Fed says. So gas isn't $4 or wherever it is where you are when you're watching. By the way, if anybody has any questions, please just type them in the chat. That's kind of the whole idea behind this, but I'd love to answer questions or be interactive at all. I just started talking about this because this is what's happening, and this could affect interest rates quite a bit. So even At 7% or a little bit more for mortgage rates, again, the mortgage rate you see quoted on Google or bankrate.com or whatever it is, and the mortgage rate you get when you go to buy a house are generally going to be different. Because it depends on a lot of things. It depends on the size of the loan. It depends on your credit. It depends on the term. It depends on the bank. It depends on who you're lending with, all those things. But 7 to 7.5% Colleen, don't have any questions at the moment, but thanks. Thank you, Colleen. You're the best. Shout out. We can do that. 7 to 7.5% are kind of where they are, for a normal 30-year conforming loan. Even with that, the housing market here in Denver is very hot. I made a few offers last weekend. We didn't go super hard. We didn't go over asking price on any of them. And I believe all the homes went for over asking price. This was at a higher price point. This was just over $1 million on both of them. And that is probably the hottest segment of the market right now, under 500,000 and over $1 million, because those two segments are less affected by mortgage interest rates, because obviously under 500,000, which it's becoming increasingly difficult to find Denver homes under 500K, but you can, it's a smaller loan. So it's not as affected by the mortgage rates. And then over $1 million, a lot of the times that is somebody who has a lot of cash from a different home sale, who may need a loan, but not a huge loan. A lot of the time that is someone who's 1031 exchanging an investment property, something like that. So the segments of the market that are less affected by interest rates are the hottest. But honestly, guys, where we are right now in March, the market has heated up considerably from where it was just 6 months ago. It is the homes that are priced well, that are staged, that have professional photography and presented like any professional real estate agent should, which is not a given, let me tell you. Those homes are generally getting multiple offers in the first weekend. And I've said this on all my market reports, so I won't go on ad nauseum. The homes that are overpriced, that aren't in desirable locations, that are a little sloppily done, those will still stick on the market. And when we are in a multiple offer situation, what does it look like? Generally over asking price, but nothing like it was in 2021 or really in 2022, the early part of the year was when things went nuts. So, then homes were going 60, 70, 100,000 over ask price. Now it's 2%. It's of the list price. It's $10,000, $15,000 over asking, something like that, with fewer concessions. I did see some limited inspections. It's one offer tactic people will put in to make their offers stronger with a limited inspection. Some people will waive it altogether, which is a terrible idea. I will just go ahead and say that right now. It is never worth waiving your right to inspect the home, no matter how much you love it, because that could be $100,000 or more in things that you didn't see because you didn't inspect the place. So there's always going to be another house. Don't take the cheese. But when we see people starting to limit inspections, saying, hey, we won't negotiate on anything but health and safety items, that's something that's pretty common. That's when you understand, that's when you start to see it is a pretty strong market. So we're in the spring market right now. And this really started in January, and it's picking up. So it's a good news for home sellers. Now is the time to go for sure. And it is, if you're a buyer, there's still opportunity, and it's a heck of a lot easier than it was the last couple of years. Aaron asks, what have you noticed in regards to cash buyers, more or less prevalent? Great question. I would say equally prevalent or a little less prevalent. A year ago in the frenzy, sometimes it seemed like cash was the only thing that would get it done on a lot of these houses, to the point where a lot of the lending partners that I work with, their banks, their lending institutions have started cash buyer programs. So where they'll say, okay, we're the bank, we'll buy the house cash, then we'll assign the contract to you. So basically it's a little more complicated than that, but it basically makes, your offer look like cash. And it was to the point where some people were needing that. I mean, it almost seemed like you needed a cash offer. So that was probably more prevalent, at least last year, early part of the year. There's still a fair amount of cash buyers, but a lot of those cash buyers, like just anecdotally, one of the offers last weekend, we lost out to a cash buyer. And we made a good offer. We actually went over asking price on that one. This was 2 weeks ago almost at this point. So slightly longer ago, but we went over asking price and we lost to a cash buyer who was about at the same price point as we are. And it was like, okay, well, there's nothing we can do. And so that was just over $1 million. That was just at that price point in Evergreen. And so, anyway, with cash buyers, a lot of them obviously are investors. There's these might be smaller investors or maybe big investment conglomerates, but a lot of those investors pulled back in the second half of last year, which is funny because the reason that the market took a hit is because of interest rates. And if you're not utilizing a loan, you don't have to worry about interest rates. But there was so much uncertainty. There's that word again, emotion in the market. A lot of these investors who had just been killing it for the last couple of years because you buy a house and then a year later it's worth 15% more. Oh, real estate's easy. All of a sudden it's not so easy. And so a lot of them pulled back, especially in the Denver market, and said, this is too volatile. We don't want to invest here. We're going to do something else with our money. And I should say there were a lot of projections the Denver market would go down quite a bit. Zillow had Denver projected in 2023 as one of their 10 worst markets. They thought we were going to lose like 20% in equity. It's early, but that hasn't happened yet. Last year from the peak, which was about May, June, we lost about 10, 11% through the rest of the year. And now from that 10, 11% drop, it's hard because it's only been a few months of numbers, but it's probably up a few percent too. So the entire time in 2023, because our supply is still so low, our inventory in Denver is still so low, the most likely scenario always was and still is a flat or a few percent appreciation this year. And so some people say, oh, that sucks. Everybody was absolutely slaying it the last few years. I don't want, but 3% appreciation, that sounds awful. Guys, typical appreciation in a healthy real estate market is 4% per year, which is great because if you look at it over time, that's tremendous. The way it compounds and builds your wealth while you're paying down your mortgage. And so it's just becoming a much more normal market. And that's what's happening. And the shock of interest rates, I remember having people saying, people were getting 3.5% when they started to go up a little bit and say, God, that just feels so high. I feel like I missed it, and now we're at 7. The shock of them coming up so fast has worn off a little bit. And so it is, people are out there and still buying with the understanding that you have to be able to afford the monthly payment right now. And at some point, those rates will come down. Some point they will. I don't know by how much, or I don't know when. I think 2024 is looking pretty good. But if you can afford it for now, you can just refi when those rates go down. And the other most common question I get is, okay, but is it really that easy? The answer is basically yes. Yes, it is. A refinance costs anywhere from $1,500 to just over $3,000 in closing costs that they can generally roll into the loan. And if interest rates drop by 1% or more, the savings you'll get on your monthly payment are going to be significant. We're talking about hundreds of dollars a month, depending on the size of your loan. And so that, whatever those closing costs are there, those will get eaten up pretty quick in your monthly savings. So you're never going to get, you can never refinance the purchase price. You can always refinance the mortgage. So there's some relief for people. The crappy part is that you have to be able to afford it now. So there are some people just saying, Dad, don't worry about it. No, worry about it. You have to make it work now. And so that may mean adjusting the type of home you're looking for, or just adjusting your strategy. And so, that's basically where things are right now. And so we're going to see what's going to happen with these interest rates in the future. But this collapse of the Silicon Valley Bank, it will be an interesting few days, because that's what's going to happen. There's a big meeting here next week from the Fed too. It seems like they always have a big meeting. But other things happening in the market are, generally inventory starts to rise and really peaks around late May into June. The reason our inventory is so low is sellers have been slow to get on the market, because many of them are locked in at a rate of 3 or 4%, and they don't want to, if they don't have to move, they won't. because they don't want to pay that higher interest rate. For cash buyers, it doesn't matter. And obviously, people still need to move. Nobody moves for a rate. That's something we say. You don't move because of a rate. A rate is a factor that comes into play when you're moving. But there's all kinds of life events that make people need to move. And so those are the people who are moving. So it's still happening. And that's basically the rundown there. It's going to be an interesting time, guys. And I am very curious to see what happens as far as a housing collapse. That is still ranging from unlikely to borderline impossible, because there's three factors that need to be present. So widespread job loss is the big one. So we have to have a crisis that causes people to lose their job. So far, we haven't had that. Could happen if this recession that everybody's been expecting, or maybe already is here. If that comes, then sure, that could happen. Second thing is homeowners need to have a lack of equity. Many of them need to be underwater because if you have equity when you go to sell, well, fine, you can just sell. If you come into a crisis, you can sell your home and make some money and get out, or at least break even. We have way too much equity in our market because of the appreciation we've seen in the last few years. And then the third thing is a dramatic oversupply. So you can't sell your house if you want to. Supply is still under 1 month of supply, which puts it into extreme seller's market, even bumping it up to like 3 months of supply, which is where it was in the winter months around the holidays. That is a more normal, healthy, balanced market. So those factors just aren't present. Carbon freeze. Have you seen a change in the percentage of homeowners versus investor buyers? Great question. Yes. So it's weird because I work with, or am getting at least a lot of calls from investors just because of some of the content I've put out there. A lot of people want to know more about buying an Airbnb short-term rental property because those can be very, very lucrative. So a lot of the calls I get are about those types of things. But that's just anecdotal. Otherwise, there's still a lot of investors out there, but the investors are looking for deals. And deals they're hard to find in this market right now. They're a little easier to find in the fall and the winter, around the holidays. They're harder to find now. So investors, I'm seeing investors pull back. A couple of those large institutional investors basically put a pause on their operation in the Denver market. BlackRock or whatever subsidiary they had buying homes, they're one of them. And so it does seem to be more homeowners probably are a percentage of the buyer pool now. They're the ones that are most affected by interest rates though too. Investors generally are coming with cash. Not all of them. A lot of them were financing during the really, really good times when money was free, because money was free. But now it's generally, if you're an investor, you're going to have cash, or somebody who's trying to use this as a high cash flowing property like an Airbnb, which you can only do in a few parts of the Denver metro. A lot of them ban it if it's not your primary residence. So great question. Yeah. Otherwise, what was I going to talk about? Oh yeah, Open Door. Got a video coming out this Thursday about Open Door. I hesitated to make it because I felt weird because I was kind of targeting listings that were owned by Open Door. Open Door, if you don't know, is an iBuyer. They are like, they're one of those companies that says, hey, we'll make you a cash offer on your home. We'll buy your home from you, and you don't have to do anything. You don't have to do showings. Here's your offer, take the cash and go. And it was a really good thing for a lot of home sellers because these companies made a lot of bad deals and bought houses at the height of the market and kind of overpaid for a lot of them. And now obviously their model is to some of them fix up and some of them don't really do much to, but to turn around and sell them and try to make a profit. Well, after what's happened with the market, that's becoming harder and harder to do. So a lot of these houses from these iBuyers, the ones that are left, are sitting on the market, and they are, there's some deals to be had because they're trying to offload this inventory of homes, and their investors are pissed. They just want to get their money out, and to get their money out, they have to sell all these houses. So there's houses that have been sitting on the market for 6 months, 9 months, stuff like that, that have had just been very mismanaged in terms of the way they've been listed and had lots of price drops. And there's an opportunity there if you're a buyer, especially when you're buying it from a company, because they're less emotional about the sale. And I always find that to be a plus. They just want to sell it. They just want to be done with it. So just for example, the last deal I did with Open Door it closed in February. And we initially they listed the home for $615,000, and we got it for $480 with $12,000 in additional seller concessions. It's a nice house. It's in Morrison. It's close to Foothills. You can drive to Red Rocks in 5 minutes. So, point being, there's opportunities out there if you know where to look. And that video is coming out Thursday, where I kind of go through the whole thing, where you can find these places without even a realtor. You can just do it by yourself. So, yeah, tune in if you want to see that. But otherwise, thanks guys for tuning on. This was awesome. Thanks for asking questions. And I'll plan on keep doing these Mondays so long as this actually went to YouTube, which it seems like it did. So love you guys.